Hello traders, welcome to my channel. So today I'm going to be explaining a strategy. I call this strategy the triple exponential breakout. So let's first of all talk about the indicators. So if you go on the indicators, we have three moving average. The first one is the 200 exponential moving average. So you can take a screenshot, and these are the parameters. So you can quickly take a screenshot. So you can put a color of your choice, but mine, the 200 exponential, is color red. Okay, then we go on to the next moving average. We have the 50 exponential moving average. So these are the parameters. Just take a screenshot and you have this setup. Then we go to the third and last moving average. We have the 10 exponential moving average. Mine is in color, in the green color or lime. Okay, so these are the three moving average, the triple exponential moving averages. So as you all know that with moving averages, they act as support and resistance. So you can use them for that. They also act as trend indicators. So in this example that we have here, in this example, if you check here, the moving average is acting as a level of what? Support and resistance. We have the blue one, which is the 50 exponential, and the green one, especially this one, is acting as a level of resistance. The moment that the price tries to go near that area, there are more spikes that are coming from there. So if you're a spike trader, you can take advantage of that fact that one, the especially in crash, you have to identify the facts that the 200 exponential average is pointing downwards, indicating that there's a downward trend. Then you can use the 10 or the 50 exponential average, exponential moving average, as your entry points. For example, you know that once there is a break off, I didn't want to talk about that. Okay, let me just explain a little bit about the strategy. So here we have the price. In crash, you're looking for opportunities where you can sell, but you're not going to sell whenever the price or the market is above the 200 exponential moving average. Here you're not going to do anything, so you wait. The moment that there is a breakout on the on the 200 exponential, that's when you want to enter the market. There are high chances of you catching more spikes. The moment that there is a breakout, we're talking about this area where there was a spike and it broke through the through the 200 exponential moving average. This is where you want to start trading. So you know that if there is a breakout, the 200 exponential moving average was acting as a resistance, as a level of support. So once there is the break of that structure, we are now expecting more a change in the direction of the of the market. For example, here there's a break, then sometimes immediately or close to the 200 exponential average, and it there will be a spike. Sometimes it can pass the 200, then it will bounce back. Like here, it passed, then it came bigger. Then here, you could see that the market was, there was a consolidation area here at this level. The market was consolidating here. Then, after that, there was a big spike. So you could enter the market here. You entered here. When there was this breakout, you entered here. And maybe probably your stop loss was somewhere here. You're going to catch all these spikes. Okay, the moment that you're now in a downward trend, you now know that I'm now officially in a downward trend. You can enter here, catch these spikes, then you exit. Okay, your exit can be the 10 exponential average, moving average. For example, here at this area, you could exit here and wait for another opportunity. So you can wait when the market comes close to the 200 exponential here, and then you enter. Immediately, less than 2 or 1 candle, there will be a spike. All these spikes came from that movement. So now you're now knowing that I'm now in a downtrend. Then you wait. You always wait and try to enter the market using the 10 exponential. You enter here whenever the price is close to the what? To the 10 exponential. You enter here, or maybe when it's closer to the what? To the 50 exponential. You enter here, there was no spike, then you wait for another opportunity, it was here again, then you enter here, you're going to catch all these spikes. So now when the market is now in a strong trend, you use the 10 exponential moving average is your what? Your entry. Whenever the market gets closer to the what? To the 10 exponential moving average, you'll be entering the market. You see here, here. So I explained about the fifth exponential moving average is a breakout strategy, the moving average breakout strategy. Here, for example, when I explained that, this is just to build up on what I said last time. If you want to catch more spike using the fifth exponential moving average only, you have to wait for an opportunity when the market is below the 200 moving average. For example, here, then there was this breakout, then you're going to catch this spike. All these spikes, you're going to catch them. And I talked about using the what? Using the moving averages. I talked about using the trailing stops. That once you are in a downtrend, you can take advantage of using trailing stops, where you'll be moving your stop losses so that you can ride the trend. So if you want to use only the 50 exponential, you can only wait for a breakout of the 50 exponential while it's under, the market is under the what? The 200 exponential. That's what you can also do. Okay, but here you can see that the 10, whenever there's a strong trend. Okay, how do you know that the trend is very strong? You see the gap here, the distance between the moving average is very huge, is very big. So you can make use of the this line, the green line, which is our 10 exponential, for your entry. Or you can move your stop losses. Sometimes when you move out of the market, then a spike comes and you're not there. Because when you're spike trading, you don't want to miss any spikes. You don't want to miss any spikes. So you have to make sure that you maximize a period where there are more spikes. That's where you make money, because spikes, they really come, they take long. Okay, here, whenever there is now, so your entry will be the breakout of the 50 exponential, while the 200 is above this line. So here we could say that's another strategy. There's this breakout, you're going to catch this spike, and you move with the trend going downwards. Going downwards, you're going down, you're going to down. Then once there is again a breakout of the what? Of the 200 of the 50, the blue line, the 50 exponential one list. Once there is a breakout of that, you can exit. So your exit will be somewhere here. So you entered the market, you entered here and you're enjoying these spikes, then you exit somewhere here. Once again there is another, because we are still in a downtrend, once again there is another break of the 50 exponential. Here we had more breakouts, but unfortunately the spikes were not coming. But on this point here, on this area, there was a breakout. So that means if you entered here, you're going to get more spikes. So your exit, you use the 50 exponential as your entry, and you ride the trend. So sometimes you can even move out of the market, then you end up using the 10. That one is a little bit risky because there are chances of missing the spikes. But you only exit whenever there is a breakout of the 50 exponential. For example, here there is a breakout, I'll exit here, because I'll now know that there is a possibility of a change in the direction of the trend. As you can see that now we're going into an uptrend, and the 50 was now acting as a level of support. You see, as the market was going up, the 50 exponential was acting as a level of support. Then again here we have a good example again. If you check here, the market was able to break through. Okay, here, let me remove this. Okay, it was able to break out from there was a breakout on the what, 200 exponential. Again, there were more spikes. So you can use the 200 exponential. Once there is a breakout where the price or a spike breaks through the what, the 50 exponential, so we're talking about crash, it breaks down, going downwards, you know that there are going to be more spikes. So you can use this moving average to catch spikes, and now your 50 will be acting as your exit. So this is what I do whenever I'm trading. The triple exponential or these moving averages, exponential moving averages, are always there. They are always there. Let me check if here, yes. Okay, so this is a good example. Currently and there was a spike. I wanted to show you that we're going to enter here because the market or the price is still below the 200 exponential. So we entered here. Okay, there was this spike, so we're going to enter. In most cases, I normally wait for the 10 exponential here, so that's where I will enter. I'll enter when the price comes close to the what, so I can enter here immediately, maybe 2 spikes, then I exit, then I wait for the 10 exponential. Whenever the price is closer to the 10 exponential, I will enter. So I was going to enter here, I would have entered here and wait for 2 candles. If there's no spike, I'll exit, then wait for the 10 exponential. Then as you can see, immediately there was a spike, a big spike. So this is what you can do to catch spikes using these moving averages. This strategy is very, very powerful. I wanted to do a live demonstration where I clearly show you guys how you can use these moving averages. Okay, so that's it. Okay, let's look for an example in boom. Okay, in boom, we have here, we can expect more spikes here because there was a what? There was a breakout of the 200 exponential, which is the red, and we can expect more spikes here. There is a possibility that there can be more spikes here on this area. Okay, but I want to do a big testing where I show you clearly that this strategy is very, very powerful. Okay, here there was a spike. So sometimes the market a spike can come and the market tries to go beyond the 200 exponential, but there will be more spikes. As you can see, there was this spike because there was the break of structure here, so there was this spike, and you probably are going to miss this one, huh? But here, whenever the price was coming closer to the 10 exponential, you're going to enter. So you would enter here and catch this spike. Okay, I'm just waiting for an example here. Let's do a background, but I know that on this area there's going to be a spike, so I can wait for the 50 exponential. It is now acting as a what, because what actually happened here is that it's not only the 200 exponential. The breakout was not only on the 200 exponential, but also on the 50 exponential, which is a very good indication that there are going to be more spikes. So here I know that there are going to be more spikes. Let's just do a big testing of this strategy. Here again, we can see that there was a breakout on the 200 exponential, and here I was going to enter here when the price was closer to the what, to the 10 exponential. So my entry is here, so I was going to be able to catch this spike and that spike. Then I will exit. Okay, let's check. So it serves us, because when I've noticed that spike traders, we normally suffer. I'm a spike trader. I tried doing the scalping. Whenever a spike catches you, your account is blown. Okay, here there's a good example. The reason why we normally suffer, it is because of these stretches. You'll be waiting for a spike. There will be smaller spikes. Whenever the price is now below the 200 exponential, we're now in a downtrend, and there are less chances of catching more spikes in a downtrend. So would rather wait for the price to go up, for example here, we have the price was down, it was below the 200 exponential. The moment that it was up, for example, here on this area, this is a very good example, there was a breakout. So sometimes you can also look at the size of the candle. If a greater part of the candle is managed to cross the 200 exponential, you know that it's an indication again that there's going to be more spikes. Here it came, there was this spike, so you're going to enter here. When the price was closer to the 10 exponential. So here you're going to catch the spike, and then you move your stop loss, because your stop loss probably was going to be, it depends, you can put it here, maybe 5 candles or 5 to 10 candles, so probably it was here, so you move it here, then you wait again, you're going to catch this spike, or you exit. You can exit and enter here when the price was close to the 10 exponential, and you're going to get all these spikes. So we need to maximize as spike traders. Whenever the market is now in our favor, we need to maximize. You can increase your lot sizes, because that's when your payday is. That's where you get more profits. So you can see here the price, the 50 exponential is now acting as a level of support, and you use the 10 exponential as your entry. You'll be able to catch. So you only exit when the price, so you entered here, then you exit when the price breaks through the 50 exponential. You can exit there. But once the price, as long as the price is above the 50 exponential, you wait, because you know that there are going to be more spikes. Here you're going to exit. Probably here you're enjoying this trend up to this point, so you're going to exit. Maybe you entered here expecting for more spikes and there was nothing, so you're going to exit somewhere here, because now you can see that the market is now going down. So what is also important is this. I've noticed that through my years of trading boom and crash, spikes normally happens when there is a level of support and resistance. So you can actually draw your key areas, your key points, your turning points, your support and resistance, and you know that in these areas the market is going to reverse. So like here, I have my support, my resistance level. I know that the market was going up, so I know that in this area probably the market is going to reverse down. So this can also guide you. So in boom and crash, no matter what strategy you may come up with, as long as that strategy doesn't encompass the support and resistance, chances of getting spikes are very low. Spikes normally happens in areas where there are support and resistance. So thank you for your time. Please, if you haven't subscribed to my channel, please do so. Subscribe, hit the notification bell, share, like and comment. Please, your feedback is very important. Thank you so much for your time.